The downfall of a titan. Why Nike is facing its worst performance in years. Nike, a name synonymous with sportswear dominance, is facing one of the toughest challenges in its history. The company, which holds a commanding 38% share of the global shoe market, has outpaced competitors for decades. Yet, recent performance metrics indicate that Nike is grappling with its worst performance since the late 1990s. This decline is not merely a blip, but a consequence of a series of strategic missteps, market dynamics, and changing consumer preferences. Management shakeup and strategic shifts. The roots of Nike's current predicament can be traced back to a significant management shakeup in early 2020. Mark Parker, a veteran CEO who had been with Nike since 1979 and led the company through some of its most triumphant years, stepped down. His successor, John Donahoe, brought a different background, having led tech companies rather than sportswear giants. This transition marked the beginning of a new era for Nike, emphasizing the consumer direct acceleration strategy. Under Donahoe's leadership, Nike drastically shifted its business model to focus heavily on direct-to-consumer (DTC) channels. This shift was seen as a strategic response to the growing importance of e-commerce, which had become a lifeline for many companies during the pandemic. By the end of fiscal 2019, Nike's sneakers app had doubled its number of monthly active users, and sales through the app accounted for roughly 20% of Nike's digital business. The digital bet and its fallout. Betting on the burgeoning digital market, Nike invested significantly in developing its digital presence. This included creating global store concepts and 4 mobile apps to encourage customers to move to Nike's DTC channels. Initially, this shift appeared successful. Membership to Nike's digital platforms grew to 160 million users, and by May 2020, digital channels accounted for 30% of Nike's sales, 3 years ahead of schedule. However, the digital bet began to falter as pandemic lockdowns lifted and consumers returned to brick-and-mortar stores. Nike's direct sales started to decline, and the company faced substantial supply chain disruptions. By late 2022, Nike was hit with an inventory glut amounting to nearly $9.7 billion, the highest in its history, leading to a significant drop in share price. Reassessing wholesale partnerships. In its aggressive pursuit of DTC channels, Nike severed relationships with many wholesale partners and cut back on merchandise sold through remaining clients. This move backfired as wholesale channels had traditionally brought in substantial revenue, $25 billion in 2019 alone. Realizing the necessity of these partners, Nike had to rekindle these relationships, but the damage had been done. Wholesale partners welcomed Nike back, but it wasn't enough to immediately rectify the situation. Inventory and innovation challenges. Nike's inventory management strategy also contributed to its struggles. To protect brand value, Nike resorted to widespread discounting, which undermined its premium positioning. Moreover, fashion trends shifted, and Nike's once popular models began to stagnate. Competitors like Hoka and On Running gained traction with innovative designs and technologies, attracting consumers who had previously been loyal to Nike. Nike's emphasis on innovation, which had been a cornerstone of its identity, seemed to wane. The company's historical strengths in performance running shoes were challenged by newer brands. Despite introducing groundbreaking technologies like the Air Max Bubble and Flyknit, Nike struggled to keep up with the rapid pace of fashion and consumer demands. Competitive landscape and consumer preferences. The competitive landscape has become increasingly fierce. Newer brands and longtime rivals have made significant inroads, while Nike's products began to stack up on clearance racks. Retailers slashed prices on Nike sneakers at nearly double the rate compared to 2 years ago, indicating weakening demand. Fashion's fickle nature meant that living off new colorways of old models was not a sustainable strategy. The turnover rate for fashion shoes is shorter than 5 years, and Nike's approach of maintaining product lines through scarcity and allure proved insufficient. The Jordan line, for instance, has been successful, but it represents a small portion of Nike's total consumer base. Strategic realignments and future prospects. Despite the challenges, Nike is not without its strengths. The company's pricing power remains strong, largely due to its meticulous marketplace management. Nike has started to realign its focus towards innovation once again, announcing new footwear and apparel products to kick off a multi-year innovation cycle. This continuous stream of new products is essential to maintaining consumer interest and market relevance. Nike's sheer size and market dominance allow it to make bold moves without incurring excessive damage. The company's recent endorsement deals, including a partnership with Caitlin Clark and the German national soccer team, demonstrate its ability to pivot and invest in strategic partnerships. Conclusion: Nike's current struggles are a testament to the rapidly changing dynamics of the global marketplace and the importance of strategic agility. While the company's digital strategy initially showed promise, the overemphasis on DTC channels and the underestimation of traditional wholesale partnerships led to significant setbacks. Inventory mismanagement and competitive pressures further compounded these issues. However, Nike's strong brand identity, innovative potential, and ability to adapt offer hope for a turnaround. The company's renewed focus on innovation, strategic partnerships, and market segmentation could help it reclaim its dominant position. The road ahead is challenging, but Nike's history of resilience and reinvention suggests that it is well equipped to navigate these turbulent times and emerge stronger.